Hi. In this lesson, we're going to get into the different kinds of leases, the different names that are given to leases, such as gross lease, net lease, percentage lease, and so on. In fact, let's start right out with a gross lease. The gross lease represents a lease where the rent is a gross income to the landlord. In other words, the landlord pays expenses. So the landlord gets a check from the tenant, and then the landlord pays the insurance, the repairs, the maintenance, the property taxes, all of the expenses relating to the property. So at one extreme we have this gross lease, gross income to the landlord pays expenses. On the other extreme we have the net lease. In a net lease, also called sometimes a triple net lease, in a net lease the tenant is the one paying the expenses. And you see I have a picture here of an industrial building. So let's say that you're the tenant, you want to rent this industrial building, but I, the landlord, don't want to be involved in the maintenance and repairs and so on. So I lease the property to you on a net basis, meaning that the rent to me, the landlord, is net income, so you, the tenant, have to pay all of the expenses, repairs, maintenance, insurance, even property taxes. Now, the only thing that I might remain responsible for as the owner of the property, as the landlord, is if I do have a mortgage on the property, I'm the one that's going to have to make the mortgage payments. So compare those two, a gross lease where it represents a gross income to the landlord pays expenses, versus a net lease or triple net lease where the tenant pays the expenses and the rent represents a net income to the landlord. Next one is a percentage lease. And Elcon happens to be a shopping center here in the Tucson marketplace. So a percentage lease is common in retail situations. Shopping centers, whether they're big shopping centers or smaller shopping centers, potentially like neighborhood shopping centers that might have a grocery store as an anchor and a number of other satellites. So a percentage lease is a lease in which the tenant pays the landlord, typically a base rent or a minimum rent, and then plus or a percentage of the tenant's gross income from their business. Now think about a big mall in your area. How many days a year is that mall closed? Maybe 2 days. Thanksgiving and Christmas. All the other days of the year, the tenants are required to be open for business. And the landlord keeps track of the amount of business the tenant does by actually requiring that the tenant's cash registers or points of sale equipment get tied into the landlord's computers. In these big shopping centers, every dollar counts to the landlord because the landlord is probably going to get a percentage of that sale. So a percentage lease is a lease typically on retail properties where you have businesses selling products where the landlord receives a percentage of the tenant's income along with or instead of a base rent. Well, I shouldn't say that. There's always a base rent, a minimum rent required, and then it's plus a percentage of their income. The next one is called a ground lease or a land lease. And in a ground lease, the tenant leases the land and typically then erects their own building. And at the termination of that lease, typically 20, 30, 40 years, the building reverts to and becomes the property of the landlord. I had a situation here where we had a property that had an old building on it, and the company that you may be familiar with is Family Dollar. They were looking for a location and they came to us and started to negotiate with us to lease, not to buy, but to lease that property. They would have erected their building, and at the end of 30 years, which that was the term of the lease they were negotiating, we would then own the building as well as the land. Now, that transaction never occurred, but there are transactions like that that are commonly negotiated. If you go to Hawaii, take a look at some of the real estate brochures and ads. They will oftentimes say LH, meaning leasehold, or FH, meaning freehold. It's because a lot of properties in Hawaii were built on leased land. The next one here is called a sale leaseback. and I have a Chevron station there for a specific reason. Because oftentimes gas stations and also companies like Walgreens, they want a specific location. They want a big corner property. And what they'll do is they'll go in and they'll negotiate the purchase of that property. Let's presume it's vacant land. And then they will build their own building on it to their exact specifications. But they don't want to keep their money tied up in that real estate. So what they do is they find a buyer for the property who is willing to lease the property back to Chevron, and then Chevron simply writes a check a month to that owner. So Chevron buys the property to build their building, but then sells it and leases it back. That's referred to as a sale leaseback. What are the benefits? Well, the seller now becomes the tenant, and the seller now has working capital. Chevron's pulled their money out of the property and can go on and utilize that money on another project. The rent, of course, is a tax deduction, and there's no property management involved for the seller. Whereas the drawbacks, there's no cost recovery. They can't depreciate it for tax purposes, and they're not going to take advantage or have the opportunity to take advantage of any future appreciation of the value of that property. The next one here is a graduated lease or a graded lease, also called a graded lease. And I've got an escalator there because typically with a graduated lease, what we see periodic increases. First year the rent is so many dollars. Second year the rent is a little higher. Third year the rent is higher, etc., etc. That's called a graduated lease when the specific increases in rent are specified in the lease. The next one is an index lease. Now an index lease, these started way back when inflation, back in the late 70s, early 80s, inflation was rampant. So what landlords would do is they would build a provision into the lease where the rent would increase based on some sort of an index, like the cost of living index or some other nationally known index. These are not too common today, but don't be surprised if in future, if we see inflation get out of hand, that index leases come back into vogue. The next one is a lease option. Now, a lease option could be a situation where you have a lease and you have the option to buy the property at the end of the lease, or you have the right to continue to rent the property for more years in the future. I'll give you an example of a lease option that I was involved in. We rented a facility some years ago for a classroom, and we had a 5-year lease. But the landlord wanted a 10-year, but we didn't want to give him 10, so we gave him 5. But then we said, well, gee, we may want to assure ourselves that we have the right to continue this lease in the future. So we negotiated an option for an additional 5 years after that. So we had a 5-year lease with an option to renew it for another 5 years. That's a good example of a lease option. The next one here is a sandwich lease. Think of it as the subway lease, so to speak. Because with a sandwich lease, the lessor leases the property to the lessee, who then subleases the property to a third party or a sublessee. And the way the rent works here is the sublessee pays rent to the sublessor, the lessee in the middle, and that lessee then pays rent to the landlord, to the lessor. Now, some of you might be asking, well, what happens if there's some additional rent here? What happens if the lessor is leasing it to the lessee for $1,000 a month, let's say, and the lessee leases it to the sublessee for $1,500 a month? Who keeps the $500? Well, the answer is the lessee does. The sublessor, the person in the middle, would have the right to that, what's called excess rent. So that's a sandwich lease, also known as a sublease. This one here is called an anchor lease. You see Nordstrom's there. Well, an anchor lease is a lease typically in a shopping center where you have one tenant who anchors, or maybe numerous tenants who anchor that particular shopping center. Just think of a big regional shopping center. You probably have big department stores at various ends of those shopping centers. Those are called anchor tenants. Or even in a neighborhood shopping center where you have a grocery store, major grocery store. That major grocery store is the anchor tenant, anchoring that shopping center for all of the smaller satellite shops to be able to do business. This next one here is called a proprietary lease. Now the term proprietor means an owner. And a proprietary lease is the type of lease that we have in what's called a cooperative building. Now, we're going to talk about co-ops in another lesson. But right now, let's just say a cooperative apartment building, for example, is an apartment building that is owned by this cooperative association, which is owned by all of the tenants in the building. And by having shares and ownership in that cooperative association, you have the right to rent or lease one of the units in that cooperative building. That type of lease is called a proprietary lease because you're one of the owners of that property as a whole. So I want to remind you what this Arizona statute of fraud says about leases. It says that leases for more than 1 year must be in writing. So it's theoretically possible that a lease for exactly 1 year or less, even though it's not in writing, could be enforceable. But what do you think? Is it a good idea to have verbal rental agreements, verbal leases? The answer is no. And as a real estate agent, if you're ever involved in a lease transaction, you always want to put it in writing. Question: how are leases terminated? Well, once a landlord and tenant enter into a lease, there's a number of ways that they can be terminated. Let's look at them. The first one is called surrender and acceptance, or simply mutual agreement. So the tenant surrenders the property, the landlord accepts it back. The next one is called expiration of term. That's pretty simple. Remember the estate for years? Well, in an estate for years, when that termination date comes, that lease is expired. Now, it's possible the tenant comes in, pays the landlord some rent for the next month, the landlord accepts it. We now have a holdover tenancy, but that original estate for years has terminated. The next one is potentially eminent domain. Eminent domain, remember the right of the government to take private property for public use with compensation. All right, so if it turns out that because of the eminent domain, maybe the street widening, that building is going to be destroyed, then that would terminate the lease. That's what we call a condemnation clause, a clause allowing the lease to be terminated or calling for the lease to be terminated if eminent domain is exercised. Also, another provision in a condemnation clause that you typically find is that the tenant agrees that the tenant has no claim on the compensation that the government might give to the owner of the property that is being condemned. So sometimes here the government will also pay the tenant some severance damages, but the condemnation clause, which is typically found in commercial leases, will prohibit the tenant from claiming any of the money that the government gave to the landlord. The next reason for termination is breach of terms. Either the tenant or the landlord breaches some of the terms. Now, if the tenant breaches some terms, typically they haven't paid the rent, that's referred to as an actual eviction, also called an ejectment. And I want you to make a note here. It's also called what is known as the lawsuit name is called a forcible entry and detainer action. So when a landlord begins an eviction suit, it's called a forcible entry and detainer action. There's also something called constructive eviction. And constructive eviction exists where the landlord fails to maintain the property in habitable condition. In other words, let's say the elevator in a 6-story building breaks down, or the air conditioning breaks down during the summer, and the landlord doesn't take any action to fix it. Well, the tenant can, of course, has to give the landlord information that the problem exists, but if the landlord fails to take care of it in a timely fashion, the tenant can actually terminate the lease if they choose, because the property is no longer habitable, and that's referred to as constructive eviction. Now, the next one, the destruction of the property. Sure, if the building is destroyed, typically that would be cause for termination of the lease. However, in a ground lease situation, if the tenant is the one who erected the building and has only leased the land, destruction of the buildings would not terminate the lease, typically. Please realize that death of the landlord or tenant does not terminate a lease. Also make a note for yourself, sale of the property does not terminate the lease. So the tenant passes away. the tenant's estate can be held liable for the remainder of the rent on the lease. Or the landlord passes away, does not give the tenant the ability to terminate the lease. So remember, death of the landlord or tenant does not terminate the lease. Death of the, or sale of the property, let me say that again, sale of the property to another buyer does not terminate the lease. The buyer always takes over property that is rental property subject to the terms of the leases. Now, questions arise. What are the rights of the landlord and tenant? First of all, let's look at the basic rights of the landlord, the lessor. The lessor basically has the right to receive rent. Why would you become a landlord? Well, you become a landlord in order to receive rent, to earn income. So that's one basic right. The second one is the right of reversion, the right to get possession back at the termination of the lease. Remember we talked about reversion in life estates. Reversion simply means the getting it back at some event in the future. And in a lease, the landlord has this right of reversion. How about the lessee? How about the tenant? What rights does the tenant have? Well, basically, the tenant has the right, and this is my favorite term here, the right of quiet enjoyment. You can't say that loudly. Say it, quiet enjoyment. Quiet enjoyment means a couple of different things. In the simplest term, it means that the tenant has the right not to be disturbed by other tenants or by the landlord entering the property at all hours of the night. It also basically means, and what it really means, is that the tenant can be assured that no one has a superior title which would force them to lose their tenancy, to lose their leasehold interest. Also, the tenant has the right to trade fixtures. Here's a new term. We've talked about fixtures in another lesson, but what about trade fixtures? Well, trade fixtures are a tenant's personal property that are used in the operation of the tenant's business in that leased premise. So here you see a store that sells handbags. All of those shelves and other lighting fixtures and so on in that store were installed by the tenant, and therefore they're personal property of the tenant. They're called trade fixtures. Think of a restaurant and all of the booths and the counters and other equipment that the landlord, or the tenant installs at his or her expense. Those may be bolted to the floor, but they're not real property. They're considered to be the tenant's personal property. Now, at termination of a lease, the tenant has the right to take them out. But if a tenant does not remove them at or prior to termination of the lease, those trade fixtures are considered to be now the property of the landlord. So that's our basic discussion on leases and leasehold estates and the kinds of leases.